Hello and welcome back to this week's episode of Crypto. My God, the markets are looking a little healthier and I am going to take it. We don't really know what happens in 90 days when everything wears off, but in the meantime, let's ride that wave. Now, I've been talking a lot about unhealthy price movements, sort of fractures in the ecosystem and our markets and how they're just broken. And I'm glad to see that I'm not the only one. It seems that this narrative is picking up. It's beginning to stick, and I think we're going to see a positive outcome at the end of the day. Let's get into it. Now, last week, right before I signed off for the weekend, I did cover this disclosure stuff with you, right? The SEC coming at us saying, hey, we are setting up rules. And remember, I have been talking about building a real foundation for real businesses. This is, the hopes. And I will tell you, the investment landscape out there for the private deals, I mean, it's absolute shit. People are looking at these liquid tokens. They're looking at the price performance and they're saying, why would I want to invest in this? Now, there's also an interesting duality, which is that companies got so comfortable moving towards private investments that do both a token and an equity piece. Now, why would you do this, right? What is the token? What is the equity? To me, these are in conflict with each other, right? Value has to flow to one place. The second you divide value and try to feed two children at once, it just doesn't work with a business. Revenue has to go to one place. People need to know where that revenue is going, and that is going to be the thing they wanted to own. So as a result, over the past few years, many people have started to invest in equity and in the tokens just in case, so as to protect themselves from a value misflow, if you will. It's my personal belief that this got founders very comfortable being, well, first a business, just a normal company, nothing specifically Web3, but with a token attached. This all led to the token mentality becoming something of value extraction, saying, hey, these tokens can become like a point system inside of our application, but points aren't really worth anything, and therefore these tokens aren't. Tokens are meant to provide the value flow and to incentivize alignment in a decentralized network. That is the whole value proposal behind a token. If you are not going to decentralize your network, that token will never receive value. The equity component will just sell those tokens down themselves. I've seen this happen many times. They use the token as basically a treasury to the equity company. So we don't want to see that. And this is where disclosures come into play, right? We need to know about that. We need to know what the plans are. And of course, the safe harbor proposal of not only one, what is decentralization, but two, a timeline and a path to get there, markers that you need to hit in order to compliantly consider yourself decentralized, which will have real recourse to the company, to the asset price, and just how the regulators treat you, right? If you want to launch a business that gets the treatment of decentralization, you're going to have to go that path. So we're seeing the SEC put forth all of these amazing rules. I mean, honestly, this is something that should have happened years ago. It's just that we had this entirely belligerent SEC that did not want these companies to thrive. So instead of creating a set of rules to actually protect investors, they've just been assaulting the companies. Now, finally, after all these years, we are getting the treatment, which is to look at the rules that are in place for the equities market and say, hey, we can take some of these things like disclosures. They're very rational, very sane, but other parts like intermediary reporting and things where they're algorithms, not humans, I mean, they just didn't make sense. That's what the last regime just held on to, saying, nah, you can do what we've always had in place. I mean, the algorithms can't report the same way a human intermediary can. So they bungled that all together. Now we're getting a sober approach saying we're looking at the tech, we're looking at what it can and can't do, and we're taking components of previous regimes like equities, and we're bringing those back, because without the appropriate regulation, we will only have scams. That's why the meme coins thrive this cycle. They had no regulations. They had really no substance underneath it, and therefore they had no ceiling, so everyone played them like a casino. But it gets exhausting. The casino falls apart, and that's what we're seeing happen right now, similar to the NFT market in the last cycle. Now, this all kind of comes back to some weekend chicanery, which is this token OM Mantra. What Mantra is an L1 for RWAs, okay? So an L1 is a decentralized compute network. Think Ethereum, think Solana, right? What it does is that it comes to consensus on transactions, it executes in a virtual machine, and basically you try to spread these things out across a decentralized network of operators. That's the goal, to provide compute for people, to provide safety and security, and to ensure that those transactions are coming through in a trustless, permissionless way. Now, why you would need an L1 for RWA straight out of the gate, I couldn't tell you. Why build that network? L1s require validator sets. They require consensus technology. These are hard and difficult things to build. You could, of course, fork another L1, but that's not super novel. Why not just build on top? RWAs, of course, real-world assets, they never fully live on chain. Basically, we can take a metadata representation, but they sit in the custody just like they always have. Like if you put a house deed on chain, it's not going to be that if you get your wallet exploited and someone grabs that token of the deed that you lose your house. That's legitimately insane. The house will have ownership represented the same way it does today, and you will just simply have a metadata tracker. So if you wanted to put a mortgage against it, take out a loan against it, I mean, you'll be able to do things with it, but all RWAs have what is called clawback capabilities. $1 in Tether, that's an actual dollar sitting in a vault, can be minted across any chain. If you take that dollar, they can pause it. They can say, you know what, you stole this. It's not really belonging to you. And they can claw back that dollar. This is important with RWAs because these are not digital native tokens. So anyway, brings us to Mantra, the L1 for RWAs. And I didn't click the I understand button because this risk warning right here, this price of this token is subject to high volatility. I mean, let's just look at what happened this weekend. All right, opening this up here, look at this single candle of fuckery, right? That's what we're looking at right now. I can actually get rid of these other things. They're pretty useless. Volume, sure. We can see it all right here in this candle. Boom. So over the course of yesterday, we basically have this multi-billion dollar, trading at around $6 billion in valuation. Drops into the double-digit millions, right? The tens, 20s of millions. And it's like, well, what the hell happened? How did $6 billion of value just get completely eviscerated in a single candle? And what we're looking at is what happens when you don't have disclosures. So as we get a little bit more into the story, it looks like there is a single holder of the tokens, whether they were a private round purchaser who had tokens. And again, with disclosure, we would know the private round purchasers. We would know how many tokens they have. We would know their lockups and if they're even able to sell these kind of things. Or this could be the market maker. And Mantra did the low float, high FDV play from Sam Bankman-Fried. We're still seeing a lot of this, even though it's total fuckery. And I've talked about it with Aave releasing almost 90% of the tokens to the public community, whereas these other projects are now doing 6% in the float. This is the same kind of thing. This is how they push the price. Now, the team apparently owns 80% of the tokens and was buying on the way up. So they now own 90. Now, when you have so much of the token ownership on the team, you're obviously taking a very big risk to your company. You can't function a company without cash. And if your cash is all in this token that only has a 6% float and you own 90 of it, like if you sell any of it, you destroy the market. So what do? You take out loans against it, you give it to market makers, you give it to loan sharks, and you basically put those positions into a short. Remember, whenever you borrow an asset, you're shorting it because you ultimately need to sell to recoup money to undo that borrow. Now, what we believe happened is that they lent their native tokens and the price of the token itself on the market, just through the retail that was owning it, began to sell. Obviously, the markets were terrible. And they got to a liquidation price. And whoever the lender was just said, boom, exiting everything, bada bing, bada boom. Now, it was about somewhere between 20 and 30 million, I believe, worth of assets. How does that wreck $6 billion of value? If we had proper disclosures, if we had the numbers, maybe we could run the math. So this is becoming emblematic. This is very much what I've been talking about in previous episodes. It's a mixture of the non-disclosures, of the high FDV low float, of these market maker shenanigans where we don't know what the team is doing, if they're lending their tokens out, how they're trading, like what is going on behind the curtain. Again, too many shenanigans happening between the exchanges, the market makers, and these teams. So this is brutal because generally the smaller players on the teams, right, like the employees, are given upside in the tokens. So people that have been working very hard for many years are basically washed out right now, and that definitely sucks. What is positive is that this is just a lightning rod for the topic. So not only is Hester Peirce and the SEC and the Crypto Task Force coming out with disclosure guidelines, but people are starting to shout for it. They're starting to say, hey, We are getting tired of these rug pulls. They're so egregious. They're so fucking obvious. And this is Flood. He's a big trader, conversationalist, but it's depressing in this industry that we still don't have a standard of reporting requirements for tokens to be listed on exchanges. Tokenomics, inflation schedules, listing fee paid, investor and round valuations, team wallets, and how much they've sold, including borrowing, right? Very important. This is just a call that's coming up more and more. We also have Jai, a very frequent contributor, and he's also talking about it. This is a self-healing problem, basically saying top protocols will offer disclosures and transparencies. Retail will benefit from that. They'll only start buying the tokens they can trust. Everyone is now transparent. Biggest winner, like Blockworks, and I'll get to Blockworks in a second, but this is very valid, right? Like Binance does not want to see charts like this. Like Binance cares about their users first and foremost. And it's in their interest to make sure that their users are not exit liquidity. So when this kind of thing happens, it obviously hurts the trust in the exchanges. It hurts the trust in tokenized projects, and it doesn't make retail want to come back and buy. They're getting burned pretty aggressively. So Jai is taking the stance that the good projects, the ones that are doing things well and have a real business in mind and kind of have nothing to lose, they're going to go transparent, because right now that is going to be advantageous. That's going to align people behind you. And we are entering the age of the institutions. They need to run models on their investments or they will not touch it. So without this kind of information, without this transparency, you are simply not going to get that institutional backing. Now, again, this is why some of those 2017 early DeFi gems are amazing. If you remember, Aave has almost all of its tokens circulating. So not only did they give them away early to really do price discovery in a healthy way, but they're still, you're able to model it now. We can see the tokens are out there. There's not future sellers that are going to dump 60, 80% of the value on our heads. It's just not possible. Somebody would have to go buy it from the market, accumulate. And again, these are all things that are transparent on blockchain. So this is a really interesting play to me. I would say, anytime you see a 6% float and that the team has a ton of tokens, like there's no reason to buy that asset. That's a GTFO situation, because there's always the chance that you will succumb to one of these red candles. So that's pretty brutal. Now, we've seen this happen really recently with Blockworks, who's actually on the marketing side. So they do research, they do news, fantastic group of humans. I utterly recommend all of their stuff. But one of their founders, Jason Yanowitz, he got into some silly hot water. Not really his fault, but people thought that someone in Blockworks wrote a piece that was pumping their bags. Now, to Jason's defense, he was like, I don't overview every op-ed that we write. Like, I'm at the ownership level. I'm not looking at everything. And quite frankly, the piece, it wasn't great. It was just kind of a silly fluff piece, whatever. But it did lead to a lot of people calling them out, saying, hey, Blockworks, we need financial disclosures. You're going to be writing articles about these assets. How do we know if you own them or not? So this did lead them to take the first step to get into some really nice transparency. And this is something that is updated once a month. So at the beginning of every month, you can see the editorial staff sadly doesn't own anything. And that super sucks. If you're going to write about this, I think you should own it. Like, how could you be in these markets and not take the upside? But you get into the research team. We have lots of ownership. Danny K coming in with the fart coin only, probably an outperformer of the group. Good for you, Danny K. You got the advisory, Blockworks data, right? It's a pretty big team. The podcasts obviously start to open up and own a lot more. And of course, we have angel investments, specifically coming from the two owners, Jason Yanowitz and Michael Ippolito. So this is pretty cool. You get to see where their positions are. And all of this is to say we are moving towards a much healthier, more realistic, and more mature. And so all this is to say that the market is somewhat self-healing. It will take a twofold approach. There will be the players that want to be in this for the long run, and they will take that self-healing approach. Then there's the laggard, which is the SEC, which is coming in and saying, hey, not only are we going to provide you with the reality of what you need to do to stay and to win here, but we're also going to have the enforcement actions for any of you pieces of shit that choose to break the law. This is going to be so helpful. I think the crypto industry moves about 10x the speed of the finance industry. So we will probably see self-policing coming into play pretty aggressively. This mantra dump has got a lot of people who are already frustrated, like myself, just now pointing at it, saying, there it is. This is the thing that we've been bitching about, right? This is the rugging that we are so tired of that we just want to call bullshit. So with that being said, I do think this pushes us communally on a social layer towards a healthier approach, which is like, hey, if you want our money, you got to show us what's under your skirt. And this is going to be very good for the assets at large. There's still a lot of collusion with the exchanges, with the market makers. And I'll be honest, I've invested in many projects where there's some sort of negative event, positive event, and you can't really get down to the nitty gritty as to why. But if we're going to have institutional investors, if Robinhood is going to bring everything on chain, if people are truly going to transact all of their finances through the blockchain itself, we are going to need this maturity of product that comes with disclosures. So maybe not the most exciting topic in the world to like get you jazzed, but what this does mean is that retail has an added layer of protection. What we need in this industry more than anything, more than higher transaction throughput, more than cool cryptography solves, more than zero knowledge tech, which is off the hook, is we need retail to believe that they can make money here. The second that belief stops, and I would say it's pretty halted at the moment, the whole industry begins to disintegrate. We need buyers of our assets. Otherwise, what is the point of producing them? So with that being said, good luck out there. It's nice to see the markets have some green on them. We'll see how it works out. Good luck to everybody, and I will see you tomorrow.